Web3 and blockchain is disrupting many industries. One of those that we may not think too much about is real estate. The global real estate market is over $30 trillion and growing very quickly. The single-family rentals market, or SFR, is about $4.4 trillion, and that's just in the US. Tokenization using Web3 technologies allows for new forms of sales and settlement. Combined with easier asset-based financing solutions, this means that the SFR market is now available to many investors that have traditionally been unable to purchase properties with leverage. While the adoption of these new technologies may present new challenges for regulators and policymakers, it also creates new opportunities for innovation through faster, cheaper, and more transparent transactions. Welcome to W3B Talks, an ongoing exploration of the impact of Web3 and blockchain technologies on business, government, and society. My name is Doug Heinzman. I'm the Chief Catalyst at the Blockchain Research Institute. And for this episode, we are joined by Sanjay Raghavan. Sanjay is the VP of Web3 at Roofstock. Roofstock is building a leading SFR investment marketplace. Their mission is to make ownership of investment real estate radically accessible, cost-effective, and simple. Roofstock's on-chain, the Web3 subsidiary of Roofstock, is building an Ethereum-based Web3 platform to radically simplify how single-family rental properties are bought and sold. Welcome to the podcast, Sanjay. How are you today?
I'm great. Thanks for having me, Doug. It's a pleasure.
Wonderful. Well, this is a pretty exciting space, and it's one that not a lot of us kind of think about. I mean, a lot of us, purchase properties or rent properties, and those of us who are investing certainly look at various different asset classes. And this is one of the asset classes that many of us, don't have in our portfolios because it's actually pretty difficult to interact with this marketplace. Can you help us kind of understand what some of the problem to solve there is for this marketplace to be more accessible to more people?
Yeah, absolutely. That's a great question. So when you talk to your wealth manager, for example, and they talk about a portfolio strategy and allocation, traditionally it used to be stocks and bonds. And then over time, wealth managers have now started including alternative asset classes in the kind of portfolio thinking. And typically with alternative assets, real estate is a very key component of that. However, most people, end up getting an exposure to the real estate market through purchase of public REITs, shares in public REITs.
And so a REIT is what?
A REIT is a real estate investment trust. And so there's public and private REITs, but the public REITs accumulate a lot of properties in them. And just like you buy shares in a company, you can buy shares in the REIT and then get exposure to the real estate asset class through that.
So a company buys a whole bunch of properties and then you buy a part of that company.
You buy shares in that company.
Okay.
That's right. So that's always been like a strategy people have employed for years now. And there's REITs that specialize in single family rentals or commercial multifamily office buildings, industrial, and so on and so forth. The problem we see these days is that these publicly traded REITs are highly correlated with the stock market itself. So the diversification you sought to get by going into real estate, maybe it's not that diversified anymore because they move up and down with the S&P 500, right? So then if you look at what else can I do? How can I get alpha? How can I still get access to this asset class without having to participate in these public REITs? There's generally a lot of private funds that you can invest through, but these are typically available to high net worth accredited investors. And then you can also directly own pieces of real estate, investment assets. But it's a lot harder to go and buy an apartment building on your own that might be $20 million. Single family rentals, on the other hand, in the US, is a much easier entry point for people because in the Southeast, for example, you can buy a house for $150,000 to $200,000, depending on the state and city. Secondary and tertiary cities definitely have much more affordable rental housing. And so it's possible to start accumulating these SFR assets, single family rental assets, through that type of a strategy and build your net worth over time. The challenge, of course, there has been that in the past, because it's hard to buy these assets sight unseen if you're living in the coastal areas, California, New York, Boston, and you're looking to buy a property in Atlanta or Indianapolis, it's really hard to coordinate boots on the ground to figure out, if this property meets your needs and, what does it look like? What are the rehab requirements and so on? So historically, people have been buying these assets close to where they live, right? And if you're living in Indianapolis, you can certainly buy a house in Indianapolis and use it as a rental property. But it's a lot harder for people to do if you're remotely purchasing this, whether from the US or even from abroad. And so companies like Roofstock have been trying to solve that problem. And over the last 7 years or so, we've built a lot of analytics and data that we can present to buyers or prospective buyers so they can do a lot of desktop underwriting on their computers to make purchase decision. And then they still need local people that can manage the asset, that can renovate the asset, and so on and so forth. So there's still a lot of friction in the process, even though we can simplify a lot of the front end, understanding a market, underwriting a property, and so on. There's still a lot of work that needs to happen operationally, with people that are local in that particular market. So that's why it's been a challenging asset class to get into, even though it's a much lower entry point. And there are about 20 million rental units in the US, single-family rental units. Because when you think about rentals, the first thing that comes to mind is, a multifamily building, apartment complex. But there's actually a lot of SFR units that people use as rentals because there's, backyards, more space. If you have a young family and a pet, you need that space, and it's much harder to live in an apartment, 800 square foot or 1200 square foot apartment. So for that extra space and the convenience of having a yard, a lot of people do prefer these single family rental properties.
So the rental marketplace itself is a pretty attractive investment vehicle because not only does it have the price goes up, there's a capital gain component to it, but there's also a passive income component to it. Is that right?
That's correct. So the best way to look at single family rentals is almost like an inflation hedged fixed income product. And I know this is a little bit of jargon, we can unpack it, right? So it's providing yield, right? Annual cash flow return. So you're able to get some ongoing cash yield through that process. And then over a 10-year period, if the property price appreciates, that portion of it acts like a little equity kicker. So a way to think about this might be a better way to illustrate this might be a stock that has a dividend plan, for example. So you're buying that piece of stock and Apple stock, for example, it pays dividends. So you're collecting those dividends periodically, but if the price of the stock goes up over time, you can sell that and also get the appreciation through it. So in our case, because rents tend to go up, keep up with inflation, generally speaking, and they go up year over year, it's a little bit of an inflation hedged cash flow product or fixed income product. And then the appreciation really acts like that equity kicker where potentially you get a higher return on your investment. The other advantage with these, of course, is that properties are depreciable assets. So as you're depreciating these, you're actually getting a tax-deferred strategy as well in motion, because every year you can claim depreciation on the asset. And then, of course, when you do sell the asset in the future, there is a depreciation recapture that happens. But in the meantime, you're able to kind of get this tax-deferred strategy. So people also use it for that.
Okay, so this sounds like a very attractive investment vehicle that has some really interesting attributes that allows you to move against the market, hedge against inflation, has passive income potential. And yet, relatively few people actually actively participate in this marketplace because it's complex, right? You've already pointed out that it's difficult to go and find a really good property because it involves expertise and locality. It's you've got to figure out how to finance them. You've got to have capital up front that's you can use as leverage. And then you've got to have the management company that's going to deal with, as you said, renovations and maintenance and all those sorts of issues. So, and then you've got to deal with tenant relations, right? So there's a lot of kind of overhead and complexity, a lot of barriers to entry into this space. And on top of all of that, there's, a complex taxation and regulatory environment around this. So now we find ourselves at the cusp of the Web3 era. And we have some new tools at our disposal that are allowing us to kind of rethink this space, this investment opportunity, and apply some of these technologies to restructure it in ways. Can you help us kind of understand the mechanics of that and perhaps describe some of its potential?
Yeah, no, that's a great question as well. So if we go back to how traditional property closings happen, right? There's typically you first find an agent, and then you're looking for assets. You find an asset that you think might be interesting. You actually don't have a lot of information about it at this point because all you see are some pictures on realtor.com or Zillow or Redfin, and you don't really know a whole lot more about the asset. So you make an offer and through your agent, and if the offer is accepted, typically there are contingencies associated with that offer. And one of those contingencies is, I'm going to go and do an inspection on this property and look at the results of the inspection, and then I have the right to either renegotiate my offer or rescind my offer if the inspection turns out to be bad. For example, we were just this morning, I was reviewing an offer that our company had made on behalf of an investor, and the inspection came back where the damage to the property is a lot more extensive than what the initial pictures, showed us. So if we have to do a 50,000 plus rehab on it, the price at which you make the offer is no longer, a good offer, right? So you have to go back and reduce that offer price. And then, so this is the process where you're going through this, you use the 7 days or so after your offer's been accepted to try to get more knowledgeable about the subject property. And that's done through sending people to conduct a full thorough inspection of the property and so on. And there's other contingencies also, like if you're actually trying to get financing for this asset, for example, the bank requires an appraisal to be conducted before they commit to financing this purchase. And so the bank will send out an appraiser. If the appraisal comes out lower than expectation, then you're no longer able to get that loan. So there's typically financing contingencies, appraisal contingencies, inspection contingencies, and all kinds of contingencies that get built into the offer process. And it's a period of intense stress for both the buyer and seller because the buyer doesn't know what information is going to be revealed to him or her, and the seller doesn't know if the offer is going to fall through because of that. And so when you're trying to look at Web3 technologies, see what are the pain points and is there a better way to solve them? For us, when we looked at this problem, there's typically 3 to 4 or 5 weeks of process that goes on during offer negotiation, closing, and so on. And there's a lot of intermediaries involved, a lot of activities take place during this time. All of the diligence is happening, and then all of the closing also has to happen at the same time. So we wanted to see, is there a way to maybe turn this process a little bit, surface all the diligence information up front? And the analogy I'd like to provide is, you go to Amazon.com, you're looking to buy some product. All the information pertaining to that product is available to you right there, right? You can look at the pictures, you can look at reviews from other people who have bought it, you can look at all the description, everything pertaining to it. So when you make that decision to purchase it, it lands on your doorstep 2 days later, and after you make that purchase decision, you're not spending 10, 20 days trying to figure out if all the information provided was correct or not, and doing additional diligence on what you're looking to buy, right? So we wanted to bring that Amazon experience to property purchase. And so a lot of the diligence related information is surfaced up front so that you can spend whatever amount of time you want reviewing all that information, comparing it with other properties, figuring out which property you'd like to buy. What does that mean, based on the condition of the property, how much are you going to have to spend on rehab, etc., is all surfaced up front. So when you go to make that purchase decision, we want that purchase to be instantaneous at that point in time and not be stressful both for the buyer and seller, where there's kind of this ambiguity and weeks of uncertainty. So that's one part of it. The second part of it is, because these assets can be owner-occupant assets or rental assets, right? They kind of have this dual purpose. And so the financing around these assets has been built around the construct of as though you are going to be living in that property as an owner-occupant. So when you, for example, you can also get investment properties financed through Fannie Mae, but that financing process looks identical to as though you're going to be living in the property. And so you go through your personal credit underwriting. So somebody's looking at your credit score, your income, your tax returns, and going through a 2 or 3 week process of underwriting you as a borrower, even though the asset's intent is to be used as a commercial property. So we've tried to kind of take what happens with commercial real estate is all commercial asset-based lending, as opposed to let's underwrite Doug because he's buying this $20 million house, multifamily apartment building, right? So we took the same principles and said, why shouldn't a single family asset that's going to be used for rental purposes go through the same commercial underwriting? Because its use is the same as whether it's a 200 unit apartment building or a single unit that's going to be used to rent out. the use is the same, and therefore it's a commercial product. And so we came up with asset-based underwriting that can be done on the blockchain that largely simplifies the process of getting a loan. So these two things, the instantaneous settlement, which removes a lot of stress for buyer and seller, and the ability to get almost instantaneous financing on the blockchain really makes it a powerful combination, which has previously not been available or easily accessible to a lot of people.
So you've hit upon two of the big ones, right? The fact that there are a lot of transactional inefficiencies. There's a lot of friction. There's a lot of stress involved. There are dangers of reneging, and then there's title clearance, and there's the financing things and the inspections and all that kind of stuff. That they're in that process, in those processes, there's a lot of potential to optimize, simplify, make it one-clickable. And
exactly.
That's an incredibly laudable goal. The second thing you were talking about was the financing issue, which starts to bleed into some of the regulatory constraints around this, and having to kind of rethink them and modernize those regulatory constraints, and finding some new solutions to do asset-based financing and leveraging blockchain as ways of providing confidence to all the various different counterparties involved in those processes. The third piece that you didn't touch upon, and perhaps it's out of scope of what your company's working on, but I think it is part of a larger phenomena, is this idea of fractional ownership, right? That there is that smaller investors may not have the capital to put up as collateral against a loan or a mortgage, and that there's a high barrier to entry just because in a lot of places, even individual houses cost an awful lot of money, and so you need a whole bunch of capital. And yet, smaller investors may want to participate in the marketplace. So I've seen in a number of geographies around the world, interestingly, in the U.S., not quite as many. It's actually slower than a lot of other global marketplaces. But this idea that we can take a title and basically put it into a vehicle that you can fractionalize and even crowdsource or crowdfund the ownership of that property. And I've seen some models, they are kind of that mechanism is adjacently attached to property management companies and the like, and they kind of put together in a solution, even structured as a DAO. So do you see that part of the market evolving, maturing over the next few years? And what barriers, what's it going to run into? What's going to stop it or slow it down?
That's a really good question as well. So when you sort of think about this from a logical perspective, right? If I, as an individual, want to go and buy a $200,000, there's no constraints on me in the US, right? Anybody who has the money can go and buy it. And nobody is looking to say, is that a good investment or a bad investment? What happens if the tenant doesn't pay rent on time? What happens if you have to evict the tenant? What happens if you uncover a big $20,000 rehab after you purchase the house? There's all these risks that are there with homeownership as well, but anybody in the US can go and purchase a property, right? But if that same person wanted to purchase a $1,000 sleeve of a $200,000 home, we say, hey, those are regulated by the securities laws in the US, and you have to comply with them, and so on and so forth. And the reason, it doesn't sound logical, right? Like I would be much better off as an individual if I can put $1,000 in a property and just diversify my $200,000 amongst 200 properties versus having to buy one house for $200,000 and take on idiosyncratic risk that something could go wrong with it. But the reason why this is all kind of goes back to the 30s and 40s, when the Congress looked at how do we protect consumers from commercial schemes where a promoter is trying to raise money from other people and trying to put that into a commercial enterprise with some expectation of making profits and distributing these profits to people. And so when the securities laws were created, obviously Congress was not able to look at every possible scenario of what might be considered a security. So they broadly left this notion of something that would be called an investment contract, and that investment contract would then effectively become a security. And the prongs of investment contract are essentially an investment of money into a common enterprise where there's an expectation of profits primarily from the efforts of others, right? Those are the four prongs of the kind of Supreme Court case, W.J. Howey versus the SEC. And you can see that how the Supreme Court sort of said that, if you have these four prongs that are met, then it is in fact an investment contract and therefore security. And so when you look at these fractionalization products, what really happens is a some promoter saying, hey, there's this $200,000 house, I'm going to sell $100 sleeves of it or $50 sleeves of it. And while, yes, that can create democratization and it could provide access to this asset class to people that didn't otherwise have access to it, because there's a promoter involved that's collecting money into this common enterprise to invest in a property and expecting to make a profit through either their management skills or by hiring a manager to do that, but overseeing those activities, that becomes a security in the US. So then you start looking at what are the ways you can compliantly offer a securities program in the US, and typically does not make sense to register with the SEC for a single family house and issue the shares of that house on NASDAQ, for example. Right? It's just not feasible commercially. So then you're looking at exemptions from registration. And in the US, typically, for smaller assets, there's regulation crowdfunding, which allows you to raise up to $5 million, I believe, over a 12-month period. There's Regulation D, which allows you to raise an infinite amount of capital. However, you can only raise that from accredited investors. And there's a definition of that. It's either an individual making $200,000 a year or a married couple making $300,000, or you have an asset-based test that says that you have more than $1 million of assets outside of your primary residence. So there's a definition the SEC has provided for who is an accredited investor. And so it's only accessible to this sort of smaller subset of much wealthier people, which is, not really democratizing real estate, but or it's not offering this to the common person. There's also another exemption called Regulation A+. Now that requires, some people think about it like a mini IPO. It requires filing an offering circular with the SEC and a review process by the SEC and approval. And then you do have filing requirements for annual statement, quarterly statement, current statement, just like with a public company. But the level of filing requirements are generally, it's a lower threshold than if you did a full IPO. So these are some of the options available. A lot of people tend to go with either Reg D or Reg A plus if they're trying to do like a REIT structure, but offer it as a private REIT, right? So we talked about public REITs earlier during the conversation, but people also create private REITs, and these private REITs can be issued either using a Reg D exemption or a Reg A plus exemption. If people are trying to fractionalize individual properties, typically they go with Reg D most of the time, but then those are limited to accredited high net worth investors. For non-US investors, there's also another exemption called Regulation S or Reg S, and that allows non-US residents to get access to US real estate or any other US investments for that reason. But those offerings cannot also be commingled and sold to US residents, right? So there's all these different programs, and people, depending on what they are looking to do, they can avail one or other programs to essentially offer these types of assets as securities to either U.S. investors or non-U.S. investors. But again, there's complexities involved with offering.
I think that's fascinating because, I've been reading about how houses have basically become digital twins and offered for sale as an NFT. And the NFT has certain attributes associated with it. And of course, as soon as it's an NFT, it can be fractionalized. And as you're pointing out, I can see a world where there's a lot of foreign investors that would love to participate in the American real estate marketplace. And someone just takes a whole bunch of properties, turns them into NFTs, fractionalizes them, and people from all over the world own little bits and pieces, small, $10, $100, $5,000, whatever it is, and they're representing any countless number of different countries in their ownership. And then there's, as you say, there's some promoter that is managing the whole thing, but is returning both the passive income and figuring out how everyone participates in any of the capital gains. That sounds exciting. The fact that American investors can't actually participate in that vehicle in the US when anyone else in the world can is an interesting problem. But it does suggest that, we're moving into this era that we have these new constructs. The other interesting thing about the Web3 world is that it's highly composable. So there's nothing to say that we can't actually, use smart contracts to automate the distribution of the rental income to the various different shareholders or stakeholders, that we can't attach various different hedging or insurance offerings to it that are conditional, and those in fact could be collective fractionalized positions that other investors take. So you find this ecosystem of all these different components that are configuring and reassembling in different configurations. And this just sounds to me like an emerging landscape that is evolving at a very, very fast rate, and that it's going to be a real chore for the regulators to figure out how they adapt and modernize in a way that promotes the right kinds of behaviors, but at the same time protects against the real risk that the great advantages of speed and transparency that this technology offers also suggest risks of high levels of contagion. The contagions can move through marketplace. We saw this in the banking industry just recently, that technology is accelerating, augmenting the risk of contagion, spread. So the regulators have a really tough job ahead of them to figure this out. Is that right?
It's an interesting problem for sure, because I think in the last 3 or 4 years, we've seen all of the different infrastructure and stacks in Web3 and crypto come together in a way that allows interesting business problems to be solved on Web3, right? And what I mean by that is when Ethereum came out, you had this notion of smart contracts, but the smart contracts mostly worked with ETH. And, there were limited use cases with ETH or any other wrap product on Ethereum. And then in 2018 or 2019, when USDC came out, which is a stable coin offered by Circle, it's pegged to fiat 1-to-1. So each USDC can be redeemed for $1. I mean, at least they stand behind it. And so far, despite the depeg that happened during the SVB collapse, it's come back up and seems to be okay for now. So, but when you then take something like USDC and combine it with the notion of smart contracts, right? So USDC, I would call it essentially as programmable money, right? Because it's money, but it's digital and it's programmable. It can actually interact with a smart contract and it can do certain things. So this notion of combining smart contracts and programmable money means exactly what you said earlier, which is you can now use a piece of computer code to decide distribution of money to different parties. So whether it's just buying and selling a house as an NFT, where the NFT is transferred from A to B and the money is transferred from B to A, right? That's all done by a small piece of computer code. And that was not possible before because you needed a trusted intermediary. So if I'm buying a house from you, I go and put money into escrow and then we both meet around a table with a bunch of intermediaries. We're signing documents and then there's a handshake and you give me the keys and you get the money. But now smart contract and programmable money can just take care of that without any intermediaries, right? But also when you add the notion of DeFi or decentralized finance, and if you can just come and start participating in these fractionalized programs, there is a regulatory issue of finding out who you are, right? Because if you're from Russia or from North Korea, for example, you're subject to sanction requirements. And if you're coming in anonymously and participating on the blockchain, how do I enforce sanction requirements, right? So there's a lot of these types of issues that do need to be solved, and the technology is so rapidly changing, and it's like every few months there's something new that offers you a capability to do something that you didn't have before. The regulators definitely, they're hardworking, dedicated people, but they just, don't have enough manpower to keep up with all this and come up with meaningful regulation at the same time.
You just said something very, very interesting that was actually going to lead into the next question I was going to ask you. You've got these investors that could be anywhere in the world. As you pointed out, you need to perform some KYC on these people in order to comply to various different regulations. So the example you used was that they reside in an environment or in a country, jurisdiction that's been embargoed. But there also may just be more generic concerns about foreign investment control of, a certain amount of a certain asset class, because there's kind of market stability things that you care about. There's lots of things like that. There's kind of two questions here that dovetail and merge into each other. One is, in this new world, what is the target investor, right? If the current world is high net worth individuals and a subset of those high net worth individuals that are, certified investors, et cetera, in this new world, who is the target audience? I mean, if you're a neo, real estate company, who are you going out and targeting?
Yeah. So that's a really fascinating question as well, right? And we've talked a little bit about securities regulations and other KYC type regulations with respect to sanctions and so on. We haven't touched upon taxes that much so far, right? So if you look at real estate, for example, foreign investors buying real estate in the US that's being used for commercial purposes, there's FIRPTA-related issues that are involved there. And so somebody needs to be on top of that, because the fundamental fabric of regulation and tax and all that does not change just because you're using a different technology stack to interact with assets in the US, right? And so those are considerations that also need to be taken into account. Now, when you ask the question of how does this improve access, Lennar, for example, is a big builder in the US, and they do sell houses both domestically but also to international investors, as do other large builders, right? And a lot of foreign investors like to look at US denominated assets as safer assets where they can park their money without the risk of devaluation impacting them adversely and so on and so forth. So when you look at these either national builders or regional builders that are trying to sell homes to a foreign population, typically this process involves somebody sitting in UK, Germany, Finland, etc., trying to figure out how do I set up a US limited liability company and how do I move my money, set up a bank account, move my funds there, use those funds to then buy a US real estate. And by the way, if I want financing, which US bank am I talking to about it? How do I apply for financing? How do I get financing? Most of the times you end up doing these as cash purchases. So we talked about kind of the difficulty for US investors buying these assets. If you're an international investor that's looking for a safer product to deploy, and US housing generally withstands the test of time on that, it's incredibly hard to have the infrastructure and know-how to set all this up and do this now. Now with Web3, it becomes really easy because, for example, the Roofstock product, we already set up a single-purpose limited liability company and we drop the title to an asset into that. And so when the NFT is trading on an NFT marketplace, it's essentially just instantaneously resulting in the transfer of ownership in that LLC, and thus the property, you get access to that property. And if you look at that scenario and you're somebody sitting in Germany that has USDC but doesn't necessarily have bank accounts set up here, LLC set up here in the US and all that, now you can come in and buy, as long as you're KYC'd, right? Because we established that for sanctions purposes and other purposes, we do need to know who you are. So as long as you can be KYC'd, now you have access to US real estate just as easily as anybody else. So that is a very interesting phenomenon, right? Like suddenly you've now created global access to assets, which did not exist before Web3 in a sense, because, you still had to go through all these kind of tedious processes in a foreign jurisdiction to figure out how to buy assets in those countries. But now, as long as you're, KYC'd and obviously subject to regulations, you can much more easily access these asset classes. So that I think is a huge kind of opening, value add of Web3 and what is possible in the future.
That's fascinating. One question that's, kind of I've always been thinking about in the back of my mind is, will the advent of these technologies, will it change at all the ratio of kind of the rental and the ownership marketplace? And as almost an extension of that, will we see any hybridization of a rent-to-own model, right? I've been reading about some municipalities that are trying to promote accessible housing, and in doing so, trying to find ways of having the people that are in accessible housing have an increasing stake in the property that they're, residing in, because, well, first of all, there's some, there's lower maintenance and stuff when people have a stake, but also helping them build equity. So do you see any of this technology changing the traditional models and ratios that we see out there in the market?
So I do. And to give you some context here, out of the 20 million or so rental units that we talked about earlier in the US, that about 87, somewhere in the high 80s, are owned by people that have less than 1 to 10 doors. And the reason for that is because once you get past 10 units, Fannie Mae lending is no longer accessible to you. And then you have to set up, either you need a portfolio lender that will loan to you separately, and those are typically a lot more expensive than the Fannie Mae product, or you need some kind of special relationship with a community bank where you have other assets with them and they're willing to create a bespoke program for you. So it gets a lot harder once you get past 10 units and you want to build the next 10, for example, in your portfolio, right? Whereas with Web3 and the sort of asset-based financing, we can actually create a huge unlock there that didn't exist before in TradFi. So that's one example. I think Web3 technologies can increase essentially ownership of rental properties. And, we generally speaking, I think it's fairly well acknowledged that as of today, we have something like 6 to 7 million unit shortage in the US in terms of demand and supply. Obviously, in the current interest rate environment with the Feds so rapidly increasing rates, home prices have softened a little bit, and we're seeing a little bit of a slowdown in the real estate market. However, if once that adjusts and normal demand supply curve characteristics take over, then you're going to see demand for properties again, because ultimately, this happened through the 2008 crisis where we stopped building for a few years and we've never been able to catch up with that additional demand. So the demand supply characteristics are favorable, and the current interest rate environment should change in the next 6, 9, 12 months. And then once that happens, we expect people to start buying units again, and with better financing opportunities through Web3, we think that that's going to be a reason to, for more acceleration of, people getting these assets that they must have otherwise not been able to procure because of any drawbacks on the traditional lending space.
You're alluding to some other interesting issues around shifts in the demographics and in various different countries. And we're seeing all kinds of immigration-driven demand in this marketplace. We're also seeing trends in urbanization. And so there are a whole bunch of factors that are pushing on the demand side of this equation. And I think we're going to need some more modern institutions to support the new reality of this dynamic marketplace. How do you see the changes affecting the financing part of the equation, the mortgage companies? Will mortgage companies adapt to this new world, or will there be new entrants, neo-mortgage companies? Or really what we're talking about is creating new financing products for the marketplace that will be more adaptable?
I think it'll start with new financing products, right? Because, and again, when we say new, it's not that it's something novel from a financial engineering perspective. These have been done in commercial lending forever. We're just taking that concept and saying that same concept should apply, whether it's a 200 unit apartment building or a single unit house, because you're using it for a commercial purpose. But on top of that, I also see a lot more kind of fascinating use cases emerge here. You talked earlier about affordability and what other use cases are evolving around that. Recently, I had a chat with a group of founders who are looking to build a shared appreciation type model and offer it as a Web3 product on the blockchain, where essentially the owner who wants to occupy that asset needs to only come in with about 10% of the down payment. And there are other investors who will come in and put in roughly 40% of the value of the asset. So when you're going and seeking a loan, you only need to get a 50% LTV loan as opposed to the traditional 80% LTV loan. And that lowers your mortgage payment. So it makes it, one, more affordable because you're coming up with a lower down payment. And then your mortgage is also significantly lower because you're only getting a 50% loan as opposed to an 80% loan. And in these types of shared appreciation models, the expectation is that in 7 or 10 years, when your family has outgrown that property and you need to move, you have upward mobility, you sell that asset and move to the next asset. And whatever appreciation you get out of that sale gets shared in some proportion, predetermined proportion with the investors who came in on this deal earlier. So these kind of shared appreciation models, they do exist in the TradFi world, but on blockchain, it's a lot more transparent and people can come in much more easily. You can kind of see the provenance of who came in at what time on the blockchain immutably. And then any distributions that need to happen could be fed back into a smart contract and then be divvied up based on whoever is the current holder or holders of those appreciation units. So those are all, again, new fascinating things that are emerging. I think in the next 5 years, we'll see a lot more of these use cases happen on Web3.
So this is a watch this space sort of answer. Okay, I got 2 final questions for you. One is, talked about blockchain a lot, but Web3 is not just about blockchain. It's also about things like AI. And I've talked to a number of companies in the real estate space that are using AI to do many things, right? To figure out where the interesting investment opportunities are and where to build and which jurisdictions have building regulatory frameworks that would support various different kinds of ventures. And of course, we've all had these early experiences with ChatGPT and the like. How do you see AI impacting the real estate business and marketplace?
Yeah, no, that's a great question as well. So prior to 2008, for example, people never looked at single-family rentals as an institutional asset class. I mean, there were lots of rental units that mom and pop investors own, but large institutions never looked at it as an investable asset class. During the 2008 crisis, there were a lot of property price declines, and investors were able to come in and pick up a lot of these houses on the cheap. And then they rode the kind of wave when property prices came back up, and they made tremendous profits through that product. nowadays it's getting a lot more sophisticated. For example, if you're looking at the Atlanta market, right? People want to know what clusters in and around Atlanta are suitable for investment properties. And a lot of investment properties are starter homes because that's where the price to rent ratio creates a favorable return outcome for the investors. And so you're looking at not only which are the existing neighborhoods that are good starter neighborhoods that are family friendly, where you can actually buy 100, 1,000 of these assets and actually make a good rental return on it, but what are the areas in and around Atlanta that might come up next? And where should they be looking at investing next? Where should they be investing in build to rent products, for example? So you're starting with land, and then eventually a few years from now that it's going to be converted to housing. And then you're trying to make estimates on which employers are going to move in. Are the demographics a net, migration in or out? What is the population, younger or older? And so you're looking at all of these different data points, and you're trying to do some future estimation of where you should be looking to move to next. And so you can get that alpha that others do not have, right? And so big data, AI, ML, I think all of these things start playing a big role there, because now not only are you looking at a lot of different parameters in an existing area to figure out, is this conducive for a long-term investment? But now you're also looking at those data points to see where else should I be going next. That's for the next 5 years or 10 years. How do I future-proof my business? And I think that's a fascinating area. Roofstock has spent a lot of money building out exciting products where we can actually look at the map of US and say, in Atlanta, let's zoom in and see which investors own which clusters of property in which areas of Atlanta. But there's other companies who are doing similar things. And today, that's what you need to be able to make that sophisticated decision when you are looking to buy your next property or next 100 properties. You need to know, okay, which neighborhood do I focus on? If I go to X, I might find good units, but I might be competing with 10 other people. If I go to this other area, I might have lesser competition, but it's also uncertain because it's not yet developed, right? So a lot of these kind of decisioning can happen if you have access to good quality data, and then you can apply some AI ML on top of that. So I definitely see more happening in this area in the years to come.
Last question. Do you have any plans to go into the real estate market, the metaverse?
As of now, we don't think we will try to sell virtual property on a metaverse. If we do go into the metaverse, it'll simply be to reflect a real property that has been purchased as an NFT and just, give it a digital home where people can go and look at how many bedrooms and bathrooms does it have, and look at pictures and look at 3D, go through a walkthrough of the property and so on. If we do that, that's probably what we'll end up doing. But I don't think we're going to be selling virtual land on the metaverse.
Well, you actually touched on a really interesting question. I mean, I can imagine a version of the multiple listing services that is just a digital twin of the real world. And
Absolutely.
You go in and you tour it, and you walk down the street, and you go and you visit the local school, and you walk in the door and you can talk to the principal there. And wow, that's a fascinating. I hadn't even thought about that as a real estate tool.
And I think real estate companies will start, at least brokerages will start experimenting with things like that. Because, already, you do have, when you're looking to go tour a property, you can go, with your broker, and then you're allowed to go in and see the property with them. But if you're going to a new construction site, often they'll have a lockbox, and then you can do a self-showing on that. Because if you're going on a Sunday to a new construction site, the office may not be open. They may not have leasing agents there or sales agents there. And so they'll just give you a code. You can open the door, go in and look at the self-tour, the model house, for example. And so those kinds of things, you can even, before you even go to the physical location to do that, maybe you can just go and do that on the metaverse and get a much more immersive experience. So I do think real estate companies and builders, they're all going to start experimenting on stuff like that.
Well, maybe we'll see a world where we can go and get fractional ownership of the house next to Snoop Dogg's house. And by virtue of our ownership of that NFT, we get 3 days of residency so we can, chum around with Snoop Dogg's avatar. Oh,
that's right.
What an amazing world we're living in. Well, thank you so much, Sanjay, for joining us today and sharing your thoughts and insights about how Web3 is impacting and changing the real estate marketplace. And thank you all for joining us for this episode of W3B Talks. You can find out more information about Roofstock's Web3 efforts at onchain.roofstock.com. You can also find more research on this and many other topics at blockchainresearchinstitute.org. I'm your host, Doug Heinzman. We hope that you'll join us for our next episode of W3B Talks.
That was awesome.